Good morning and welcome to Friday morning's market wrap. It's been a massive night. Mario Draghi has made a play to be central banker of the century, and I reckon that there is a fair chance he's going to get this. If you remember back a few years, Europe was in a funk. The markets were worried about what was happening with the euro. The European Union was fracturing. The whole place was in a real kind of dark mood. Markets were in a mood. And it really did look like the troubles of a tiny little place like Greece might actually infect the wider EU. Mario Draghi came out and gave his whatever it takes speech. And largely from then on, notwithstanding what happened earlier this year with regard to Greece and the elections and Schuster and the negotiations and all that kind of stuff, largely Europe as a problem for global markets went away, at least in a macro sense. Draghi's done it again last night. What he did, and I think I talked about this yesterday, I know I certainly wrote about it in my report at Go Markets, he put QE back on the table. Clearly it was too early for the next round of QE in terms of, too early in the process of bringing some of his colleagues along. But Draghi, by putting it on the table, took dead aim both at his colleagues in terms of snookering them into following the market pricing, and the market has now priced QE, but he also took dead aim at the currency. And euro is down at this morning 110.99. So euro's down at 110.99. That's 230 points off where it was this time yesterday morning. Now, two things there. That should make European businesses more competitive. It's not going to fix the problems of Germany and what's going on in China, because German exports are acutely and strongly tied to what's going on in China. So in that sense, China's still important. But all other things equal, dropping the currency and making it look like it could go further is really important in making Europe more competitive. Now, of course, Europe's already running a current account surplus. That's one of the reasons why the euro hasn't been able to stay low. That's one of the reasons why, with the market ructions, Europe has had problems in the sense that money came home, which meant, of course, that the euro went up rather than down. Now, that's a different situation to what we've seen in the past. But what Draghi's managed to do now, and I'll just share my screen with you, is he's managed to really light a fire under some euro selling. Now, yesterday in my writings, and hopefully on telly on screen here, I said that I thought if he did put QE on the table, it would go, the euro would go to 111.70 and then 111.20, which is the 200-day moving average. As you can see here now, it's gone below the 200-day moving average and is now approaching this trend line, which, as you can see, goes back to the lows in March this year when euro got down to 105, that 104 high, 105 region. It's outside the bottom of the Bollinger Bands. Normally, that's a place for it to consolidate. And because of the proximity of this level around 110.50, it's only 50 points from where we are, I would expect some consolidation. Now, I always respect trend lines like this unless or until they break. But for the moment, what I would say is that there's a real chance that euro does head towards 108.50 at some point. Now, of course, the other thing that this does, if we think about it in what's the impact of Mario Draghi, is that the Aussie didn't go down last night. Of course it didn't. Stocks went through the roof. The Dow Jones was up 1.87%, over 300 points. The S&P was up, up to 2052, for goodness sake. That's supposed to be as high as it can get. We'll talk about that in a sec. The S&P actually is above its 200-day moving average for the first time since the funk in August. And I think that I'll just take a segue here. I think that what's important now is that the most available emotion to traders now is fear of missing out. Now, the sustainability of this rally, we can talk about that later. That's what I'm thinking traders are going to be doing. They won't want to miss out, though. Now, we've seen some massive bounces since the lows in August. We've seen some massive bounces since the September lows. You know, and it was looking like that resistance was going to be difficult. But if you have a look at the S&P 500 last night, and then I'll go on to the Aussie market, what you've got is the market has broken up both back into, there it is, right. Let's just blow that one up. Okay, so you can see here, this is the big fall in August, consolidation, retest, found that strong. And then now we've had this massive rally last night, this 30-odd point rally. We've taken out the 200-day moving average for the first time since, you know, back here in August when it broke down. And we've, in night trade with the Google results and the Amazon results, you're starting to see more positivity. Now, so I'm thinking that from a behavioral point of view, the most available emotion people are going to have is, shoot, I'm short, and we know that the speculative community is really, really short, or shoot, I don't want to miss out. This could be the start of the rally, blah, blah, blah. I think people do prefer to be bullish. So I think it's a less strong emotion than the selling, but nonetheless powerful. And so if we combine this little bit of positivity with the fear of missing out on the rally, then I think the onus is on something to come out and scare the market lower again. Now, things have changed a lot in the 24 hours, as you can see by me making that comment. Likewise, if we have a look at, where's that one? If we have a look at my Go Markets report this morning, this was in my Business Insider article, 20 seconds for traders, which is normally out before my Go Markets report. So let's just look at the ASX 200. All right, it failed at the range top. It came back down. If you think about the way that my system works, failed at the range top, came back down, initially found support at the fast moving average, bounced, came back down, found support at the slow moving average, doesn't break the slow moving average for me, I'm not getting bearish. All right. If you have a look at them, the slow moving average is back below the fast moving average. That means that we're in a bull trend in a short-term basis. And now we see it breaking out. So today on the ASX, we could see a really strong rally. Already futures are up 77 points in trade overnight. That's about 1.5% or so. Crude oil was up a little bit. It's back at the sort of the 45-40 region. Iron ore was down a bit. Copper, $2.38. There's lots of competing forces on the ASX today. But the market might like the fact that the banks are just hammering their customers. You know, Westpac was making, you know, 600 odd million out of their move. The CBA is probably going to make something similar. You know, that yesterday Westpac was up 0.9, I think. The CommBank was up 0.7 or 0.8. You're probably going to see those rocket by similar amounts again today. So it could be a really good market. And I think people are really worried about they don't want to miss out, put it that way. How does that impact other things? For the Aussie dollar, what's happened is that German 2-year rates went from -24, -25 basis points to -31, -32 basis points. Yes, negative rates. US rallied from 0.64 to 0.58, 0.59. The Aussie 2s were at 179, 1.79%. So there are a massive 120 points over US and a massive 200 points over Euro. So it's no surprise, of course, that Aussie Euro's gone through the roof, or Euro Aussie's crashed. And if I have a look at Euro Aussie, it's back down at the lows we saw. It's breaking down, you know, it's at 153. You could see it at 149 or something like that before this is finished. Of course, that a lot of that's going to be driven by Euro, but just another one to watch. So it's been a really interesting night. The question is, has Mario Draghi changed the game for traders? Now, rhetorically, honestly, I have no idea. right? If I look at the market and I say, you know, where's the revenues or the earnings going to come from to support the rally, that's questionable. That's been questionable for ages. So while I'm always uncomfortable with dancing with someone just because they're there to dance, you know, and I know that the music will stop at some point, from my point of view, from a technical point of view, if this ASX market breaks out, if this S&P can close up at these levels, then we're probably in for a couple of weeks of positivity, at least until we see the next non-farm payrolls in a couple of weeks' time. So it's nice to be positive on a Friday. The weekend's ahead. It's all good. So have a great day. I'm probably going to nick off early today. I've got some jobs to do around the yard. It's a lot colder, as you can see by me having a jumper on today. A lot colder here today. Summer's disappeared again, but I'm still probably going to go and have a surf. So set the levels, go and have a surf, do some writing for Business Insider. I'm going to publish an article soon about why these banks and what they're doing is really, it's disappointing anyway. The rent that they take out of the Australian economy when they have an essential government guarantee is appalling. So have a look out for that on Business Insider or on my Twitter feed at Gregory McKenna. You can also have a look at my gregmckenna.com.au website. Sign up for my free Jesse Livermore ebook. But that's it for me today. I'll be back on Monday. Have a great weekend. Stay safe, and may your footy or cricket team win. Bye for now.